All right, future CAs, welcome. Today we're going to tackle a standard that shows up all the time on your exams and is super practical. AS17 segment reporting. Let's really nail this down so you're ready for anything.
But hold on, before we get into the nitty-gritty, let me ask you something. That 10% test for the segment result, what's it 10% of? Is it the net profit, gross profit, something else? If you're hesitating even for a second, you've got to listen up. Because I'm telling you, this is the #1 trap ICAI uses to catch students, and they get people with it every single time.
So take a look at this. ABC Limited posts a profit of 500 crores. Looks pretty good, right? But what if that number is hiding something? What if their pharma division is absolutely crushing it, making 800 crores, but their brand new retail business is just hemorrhaging money, losing 300 crores? See, that single 500 crore figure doesn't tell you the real story at all. It actually hides it. And that right there is the entire reason AS17 exists.
All right, first up, the foundations. Let's really get our heads around why this standard is even a thing. So, what's the whole point of AS17? Think of it like this. It's about looking under the hood of a company. It helps people, investors, analysts, you name it, to see what's really going on, to understand the performance of each part, to see where the real risks and rewards are. This way, they can make way smarter decisions. Now, for your exam, 2 things on scope are super important. 1, it's mandatory for non-SMCs, and 2, if you've got both consolidated and standalone financials, you only need to do this for the consolidated ones. That's a key point.
Okay, next section. Let's get our definitions straight. And trust me, you have to get these right. Every calculation you'll do in the exam comes from these core terms.
All right, a company can basically be sliced up in 2 ways. You've got your business segment, which is all about what the company sells. Like, imagine a company that makes both cement and software. Totally different products, right? Different customers, different risks. Then you have a geographical segment, which is all about where they sell. Selling in India is going to have different political and currency risks than selling in Europe. But here's the key phrase for both, and you need to remember this. Different risks and returns. That's the whole game right there.
Okay, let's talk about the numbers. Segment revenue. Sounds easy, right? It's just the revenue you can link to a segment, including sales between segments. But it's not that simple. The real trick for the exam isn't what's in, it's what's out. This is where they try to catch you. Okay, listen up, because this is a classic exam trap. You have to exclude extraordinary items. You also exclude any interest or dividend income that the company earns on the side and gains from selling investments. ICAI just loves to drop these into the question to see if you'll bite. But here's the twist. The exception they love to test. What if the segment is a bank or a finance company? Well, their whole business is earning interest. So for a financial segment, and only for a financial segment, that interest income is included. Remember that. And you guessed it, it's the exact same story for segment expense. It's the operating costs you can link to the segment. But again, the real marks are in knowing what you need to kick out of the calculation. This is another big area where students mess up. You've got to exclude extraordinary items. Exclude income tax. You exclude losses on selling investments and general interest expense. Again, unless it's a financial segment. And this last one is huge. You must exclude general head office expenses that you can't logically allocate. Don't just split it 50-50 for no reason. If it can't be reasonably allocated, it stays out. That is a classic mistake to avoid.
Okay, so let's quickly wrap up these definitions. Segment result? Easy. Segment revenue minus segment expense. Segment assets? All the operating assets the segment actually uses. But again, exclude stuff like income tax assets and those general head office assets. Same logic for segment liabilities. It's the operating liabilities, but exclude income tax liabilities and general company borrowings.
All right, so we know all the pieces, but how do we put them together? How does a company choose its reporting format?
It's all about one simple question. What's the main driver of the company's risks and returns? Is it what they sell or where they sell it? If the biggest thing is managing different products, then business segments are their primary format. If the main challenge is dealing with different countries and economies, then geographical is primary. A good clue is usually how the company's own bosses look at the business internally.
Okay, here we go. This is the main event, the absolute core of any AS17 exam problem. Let's get into the reportable segment tests.
So, there are 3 main tests, all based on a 10% rule. We have a revenue test, a results test, and an asset test.
Now here's the most important rule of all. A segment is considered reportable if it meets any one of these tests. I'll say it again, just one, not all three. Pass any single test and it's in.
Okay, remember that trap I mentioned at the very beginning? This is it, the result test. Look at this example. We've got 2 segments making a profit and 2 making a loss. What do most people do? They net it out. 200 in profit minus 100 in losses gives you 100. And they use that. Wrong, absolutely wrong. Here's what you have to do. You make 2 buckets. Bucket 1, all the profits. So 150 plus 50 equals 200. Bucket 2, all the losses, but as a positive number. So 80 plus 20 equals 100.
Now you have your 2 totals, 200 from the profit bucket and 100 from the loss bucket. The rule is simple. You pick whichever one is higher. In this case, 200 is higher than 100. So your benchmark is 10% of 200, which is 20 locks, not 10% of the net 100. So any segment with a result, profit or loss, of 20 locks or more is reportable. I'm telling you, getting this right is an instant advantage over so many other students.
But we're not quite done. There's one last safety net, called the 75% test. After you've found all your reportable segments with the 10% rules, you do this final check. You add up the external revenue, and it has to be external, not internal, of just those reportable segments. And you ask, is this total at least 75% of the entire company's revenue? If the answer is no, you have to go back and pick more segments to make reportable, even if they failed the 10% tests, until you hit that 75% mark.
Okay, and 3 final little rules that are perfect for theory questions. Number 1, consistency. If a segment was reportable last year, you keep it reportable this year, even if it fails the tests now. It just makes sense for comparison. Number 2, comparability. If a new segment becomes reportable this year, you have to go back and restate last year's numbers as if it were reportable then too. Again, so people can compare apples to apples. And number 3, management's call. Management can just decide to make a segment reportable if they think the info is important, even if it fails all the math.
All right, on to the home stretch, disclosures and presentation. We've done all the calculations. We know what's reportable. So what do we actually need to show in the financial statements?
Well, it all depends on if it's your primary or secondary format. Think of the primary format as the full detailed story. You have to show everything: revenue split by external and internal, the result, assets, liabilities, capex, depreciation, the whole shebang. But the secondary format is more like a quick summary. So, for example, if business segments are your primary, then for the secondary geographical info, you only need to show 3 things: external revenue, assets, and capex. That's it.
And last, but definitely not least, you have to do a reconciliation. This part is non-negotiable. You have to show how adding up all your segment numbers gets you back to the main company totals in the balance sheet and P&L. This is where you account for all that unallocated head office stuff we talked about. You also have to mention how you price sales between segments and give a quick description of what each segment actually does.